And there you have it. That is your closing bell, sponsored by Tastyworks. Let's see how the major indices settled on this very big Fed day. Well, all three major indices stayed in positive territory after the Fed gave that remark about the 75 basis point hike. The Dow ending up more than 300 points there at 1%. The S&P 500 up 1.46% there, 1.5% up 54 points. And the Nasdaq, the biggest soarer on the day, 2.5% there, gaining 270 points. But let's break down the market action now with our guests, Christian Hoffmann, Thornburg Investment Portfolio Manager, and Jason England, Global Bonds Portfolio Manager at Janus Henderson. So, Christian, I want to start with you because in your notes, you did say that the Fed's credibility was on the line here. Did they live up to expectations?
I think they did exactly the right thing, and they had been backed into a corner. You know, previously the Fed had acted like a very cautious parent or a corporation that wants to, test everything with a focus group and not surprise anyone or harm anyone. But the CPI print last week and the market reaction to it was violent and brutal and really put them into a tough place. And given the short amount of time between the meetings today and that print, they also didn't have an opportunity to go on the road and massage the message to the market. So they did it via a nuanced way, which was leaking it to the media late Monday. The interesting thing is between last week and early this week, we'd already reacted to CPI, and again, a very, very violent manner. And at this point, 75 had kind of become a foregone conclusion, even though, 2 weeks ago it would have been unthinkable. And again, we had, relatively calm markets this morning. Post the announcement, there was really no surprise. There was very little reaction. And despite being probably the most uncertain meeting because it hadn't been telegraphed due to the back channel nature of, what they had done, there was really no surprises. I think really the only surprise that came out of today was the fact that we're more likely to do 50 to 75 bips at the next meeting, and the Fed wasn't going to go medieval.
Jason, Powell has asked a few times this afternoon to weigh in about a softish landing. He didn't bite. He didn't want to say those words. But do you think the Fed is going to be able to orchestrate a soft landing given the dynamics right now in the economy?
I think he did avoid it because he really doesn't. It's out of their control now. And he did highlight that the commodity prices and external factors like that are going to be more dependent on whether they can pull off a soft landing. So I think that's kind of why he waffled a little bit on it. I think for us, to me, I like to call it a safe landing, one of those plane rides that are very turbulent. Even when you're touching down, it's going to be rocky and turbulent along the way. And then once you get landed, you kind of feel like, okay, now you're safe. I think that's kind of what we're looking at right now. The Fed really has been backed into a corner here by the mistakes they've made on the transitory inflation. They continue to make these mistakes along the way. So I think it's going to be tough for them to pull off the soft landing. And they still think there's hope for it, but I think it's going to be very tough at this point going forward.
Christian, the markets really bounced when the Fed chair left open that possibility, or even leaning towards it 75 points at the next meeting, up more than 600 points at one point. Is that the market just saying, thank you, sir, may I have another?
I think it's a little bit of that, but I also think you have to think about the mood and the trend that we've experienced over the past week and really all year. So positioning had become so bearish, so short that, I think really anything that can cause a relief is going to cause a significant bounce. Some of that is short covering, some of that is a relief rally. We're clearly not out of the woods. I think, from here, we're going to be watching inflation data extremely carefully. I think the market also probably put too much weight on this last CPI print. It's one data print, it can be revised, and it's really the direction, right? We're probably very close to peak inflation. And as soon as we start seeing that come down, I think that's when, the true relief, the true buying will step in. It's going to be choppy from here, though. I think, again, this is short covering in a bounce.
And Jason, we did hear Fed Powell say, look, don't get too comfortable with these 75 basis point hikes. This isn't going to be a common thing, but then still leaving the door open, saying it's going to be really determined by what they see with the data points that come out. How complex is the picture for the Fed now by going 75 basis points when you keep in mind what we still need to see with quantitative tightening?
Yeah, I think he decided this time he wasn't going to handcuff himself and the last time around, he said 50 at the June and July meetings, and he didn't want to, he wanted the flexibility by doing 75 now and putting it on the table that they could do 50 or 75 at the next meeting. They're really going to be data dependent and try to be flexible and nimble, which is tough to do in this environment. As Christian said, it's been a volatile market. Start this week after the CPI print. They don't want to overreact to these CPI prints, but they also need to take them in stride and realize that they were wrong on inflation. So they need to get it under control and do everything in their power. So I think really today was trying to reestablish the inflation narrative for the Fed and trying to restore some credibility. And I think they did a good job of that.
Jason, what do you think of the bond market's reaction to the Fed decision today? The 10-year pulling back when you take a look at yields, a 2-year yield posting its biggest one-day drop that we've seen in just about 2 years. What is that signaling?
Yeah, I think it's that the market's, the Fed delivering of 75 and then the communication by Powell was well received. I think you're seeing a little bit of a relief rally that you saw, such extreme sell-offs on Friday and Monday this week and a little bit leaked into yesterday just because of that CPI print and the Fed being behind the curve. So they delivered a message that the fixed income market wanted. So you got a little bit of relief rally. I still think, as Christian pointed out, there's still turbulent times ahead in fixed income. You can still see rates go higher. But at this point, we'll take a little breather and be happy that the Fed delivered on what they needed today.
There wasn't a huge surprise in anything Powell said, except for maybe this, Christian, that there's no sign of a broader slowdown that I can see in the economy. And earlier, Andrew Levin, former Fed special advisor, said he thought that was way too rosy and optimistic. He actually sees inflation. What's your reaction to that?
I mean, we clearly have inflation and have had inflation for a long time, even, when paradoxically last year we had the, 10-year close to 1%, in the face of, sky high inflation. Look, I think it's going to be hard to orchestrate a soft landing, even though that's roughly what the market is pricing in, at this point in time. If you look at the projections that the Fed puts out, to me, that's not the future. That's a mood board. That's something aspirational. They're still trying to please everyone and, not scare anyone or do anything too scary. But we've said for years that the global financial crisis was caused by investment banks, and the next crisis would likely be caused by central banks. And I don't think we're at a crisis point at this time, but you can't print money for 15 years and please everyone and, not eventually have to pay the piper.
Well, Christian, real quick, when do you think we could potentially get to that crisis point?
Well, liquidity in the markets is actually incredibly choppy right now. Again, it feels good today, but I don't think this is going to be, continue and be lasting. And I'd also highlight that market liquidity and structures have actually changed pretty notably, in that liquidity continues to improve on very small lots, and this is for equity and fixed income markets. So there's an illusion of liquidity. There's an illusion of being able to transact. But in terms of size, due to the lack of market makers and risk takers, which again was actually a fallout of the global financial crisis, actual liquidity for size is, nowhere near what it was, 10 or 15 years ago. And I think that creates the risk that liquidity evaporates from the market and dries up, and you have, very cliffy price action. I mean, at this point, we're having, incredible volatility on a 2-year basis. We had it in 2020, had it in 2018, had it in 2016. And that's a little too much, in my opinion.
All right, Christian Hoffmann, Jason England, thanks so much for joining us today.